Give it another minute or so, and then we'll get started here. Okay, we'll get started. So thank you everyone for attending this tax credits incentives update for engineering firms. Today we're going to be focusing on 179D, 45L, and cost segregation. So we have, so most of you are used to seeing Randy on these. I know I've been on these from time to time for employee retention credits. Randy is out right now. He has COVID, so I am taking his spot for this presentation. I'm the controller of Tri-Merit. I've been involved with the company for over 10 years now in many different roles. I've communicated with our project managers for various different items from 179D, Cost Seg, 45L, R&D across the board. But with us today, we have Dave, who is our 45L director. He brings 18 years of background experience in engineering and manufacturing, and he's worked on both R&D and 45L projects within Tri-Merit. Marlon, who has over 10 years experience in architecture and engineering. He is our 179D director. And then Harry is our cost segregation director with over a decade experience conducting cost seg studies. He's also a certified member of the American Society of Cost Seg Professionals. About Tri-Merit, if you don't know us already, we support tax preparers and CPAs by essentially being an extension of them and their advisory team. We try to decrease the tax burden and increase cash flow with their clients through a variety of different opportunities, including R&D, Cost Seg, WOTC, 179D, 45L, and ERC. Our team has engineers, scientists, and CPAs and attorneys from all over the country. We have serviced clients in every single state. So we have been doing this for quite a long time, 15 years time now, and continuing to grow. As far as the agenda, so we're going to start with 179D. We'll move into 45L and finalize everything with cost segregation. This is going to be more of a Q&A type of update. So I'm going to cover everything from a basic perspective, and then we'll turn over with, I'll ask some questions that we commonly receive from clients, CPAs, and the like about each of these services. Ask these questions. If you guys have additional questions, feel free to throw them in the Q&A, and we will look at them along the way. But yeah, without further ado, let's get going. So before we get going, I guess let's actually run the first poll question, which is, have you taken 45L, Cost Seg, or 179D with any clients before? Curious here to see the mix of everyone. Remember, to get CPE credit, you have to answer these questions and stay on for 50 minutes. Looks like we have almost everyone answered. Give it a few more seconds here for anyone to get their last answers in. And there we go, we'll cut it off there. So it's a pretty even mix. It looks like 55% of people have done something while 45% have not. So that's good to see. We're going to have some people looking at some of these for the first time and some others who may have taken one of these in the past. It's always nice. So let's get going. All right, so 179D. So background history. It was created under the Energy Policy Act of 2005 and originally was set to expire at the end of 2020 until we had some awesome news where the deduction was made permanent at the end, as part of the CAA at the end of 2020. So now instead of constantly being renewed every couple of years or so, we just have it fully in place. Essentially, so who can use this deduction rate? So anyone who's a commercial building owner or designers of federal, state, or local government buildings. So we see a lot of architects, engineers, GCs, mechanical contractors. The way that works, we'll get into this a little bit, but essentially they can take a deduction on behalf of the government building owner. So what types of improvements can qualify? New construction, remodels, additions, retrofits, improvements, essentially some type of renovation improvement done to the three main components, which we'll touch on in a bit. One thing you'll notice that is missing from here is purchase acquisition. So you cannot take this on an acquisition as opposed to some of the other things we'll explore later. But 170D is limited to those improvements. So what happens is this allows us to accelerate depreciation for buildings that can meet these energy efficiency tests. So the big thing we're always aiming for is a 50% reduction in energy usage, which results in a full $1.80 per square foot deduction, regardless of which of the three components it came from. But the three components we can look at individually are HVAC, lighting, and building envelope. You can see the reduction needed for each of those, but each of those on their own can qualify for 60 cents a square foot as well, which gets us to the $1.80 per square foot deduction. One thing to note, and I'm going to talk to Marlon about this in the Q&A, but just what are we comparing against for the energy efficiency, right? It's not you have to be doing something crazy above and beyond for improvements like a lot of people might assume with energy qualifications. We'll get into more like how you compare against it and where that goes. So some commercial buildings that we typically see qualify for people. We've done lots of office buildings and retail. I see manufacturing, might people doing replacing lighting, parking garages, warehouses, kind of running the gamut across those. But the government building side is the side that most people probably wouldn't be as aware of, right? So if you have engineers or someone who's working on schools or universities, police stations, village buildings, park district building, anything like that, they can go ahead and take that deduction. Now it's a little different how they do it, and we'll get to that in the next couple of slides. But just know that just because when it comes to those public buildings, because they don't own the building, they can still go get that credit. It's a big sector, big opportunity for a lot of clients to go after, even though that they're not actually the owners. And how that works, given that it is accelerating depreciation, you would maybe think that that's not something that qualify, but they built out something specifically for that for the designers. So what do you need to do to qualify, right? So the energy and power cost savings calculations always have to be performed with a approved software by the Department of Energy. So you can't just have someone go out and create their own software without running through the Department of Energy to approve this. You have to do field inspections afterwards to essentially certify that they are meeting the performance standards in accordance with the guidelines. And any type of certifications, inspections must be completed by a qualified engineer or contractor. So we always have a professional engineer sign off on all certifications that are done. This is a big thing. You can't have someone just come in and do it for themselves. Because you want to make sure you always have an engineer signing off on these calculations in order to get them done. So for government-owned buildings, how does this work? So you have these designers that we've talked about a little bit. Pretty much anyone's doing work on either HVAC, envelope, or lighting, they can go and apply for the allocation letter from the government entity. So let's say you're working on a school building. You go to that school building, you say, hey, we did this work on your HVAC system. We're applying for the 170D energy efficient deduction for this building. We need the allocation letter from you saying that we were the designer on this project. You get that allocation letter that essentially tells you that they get that deduction. So when you go and do the test and everything, you work with the school, do the test, you turn around, and obviously a government building, they can't claim the deduction for themselves. So the designer gets the amount of that deduction on theirs, and it becomes essentially a phantom deduction. It's something that they don't have expenses into that they get to claim the deduction for. So it's something that can be really beneficial, especially if you're working on a lot of buildings like this. It can really add up over time. But again, you need a certification by an independent third party. It can't be done by themselves. And you do need to know that allocation can be split. It can be a little bit like the Wild West out there. So if you have two designers who are working on something and you go to the government entity and that government entity already gave the allocation letter to the other engineer or designer, unfortunately, you're kind of out of luck, right? If they've already gone ahead and taken the deduction with that allocation letter, there's nothing you could do at that point. So There are some parts of this that's, can be a little bit of, I guess, a race, for lack of a better term. You want to make sure if they're doing work on these buildings, they are talking to government entities up front and advising them that they are going to be going for this deduction and get that allocation letter done. As far as the government entity, it is their responsibility to decide who is responsible for designing the energy efficiency property. So again, this person may not always know all about this type of deduction. So you might have to do a little bit of education with them, what's going on, why you need the allocation letter and whatnot. And there might be times where it is split between multiple designers. We have that happen, with clients time to time, where 2 different companies are working on the same project or around the same component, and they're both getting allocation letter for that. So, but besides that, they just need to make sure that they allow access to the facility for the site inspection and that they have the basis, the adjustment for record keeping purposes. So the one thing with this deduction, because we're accelerating these costs from what would normally be, 39-year components or whatever into essentially into today for the deduction, we need to make sure that we don't exceed the cost of the project, and that 2, it's adjusted, it's accounted for on the records of the government building. So as far as the timing of the benefit, so this is for a commercial building owner. It could be any new construction or improvement, between 2006 and today can be claimed, and we just use a 3115 in order to do that, a change of accounting method. As far as designer of a government building, you're only able to claim it for any open tax year, and it has to be the year the property was placed in service. So, once you get beyond that time period, now you can't go back and claim it. So this one, there is a little bit more of a timeliness needed to do that, as opposed to the actual owner of the building. We can just make that change of accounting method with the 3115 instead of actually going and amending back the return itself. And so here's a quick example. If we have a 100,000 square foot building and we're looking at being able to qualify all 3, HVAC, lighting, envelope, everything done, you get a $180,000 deduction. So if that's at 37%, it creates a tax savings of $66,000 for this client. So for a building owner, right, we're bringing that tax savings into today from the future. So it's a time value of money benefit. But if you're the designer of a government building, like I said, it's a phantom deduction. You get a Schedule M adjustment. This is essentially found money for them because there is no actually cash outflow related to this. You're getting an expense for money that you didn't have to actually spend yourself. So again, if you have anyone who could qualify as a designer who's work on these public buildings, it's a very big benefit to talk to them about. It's a free way to essentially, well, not free, but they can lower their tax deduction with being able to claim this credit, and they don't have to actually spend the money themselves, on these improvements in order to get this deduction. So that is in a nutshell. I'm going to pull up the second polling question real quick, and then we're going to get to the Q&A with Marlon, and I will also check the Q&A because I noticed that there is one there. So let's go here. So polling question 2, do you think 179D will be strengthened in upcoming legislation? It's been around for 17 years and has remained for the most part pretty much unchanged. So energy is always a hot topic in DC right now. It's something we'll be keeping our eye on. All right, so it looks like most people are answered. I'm going to go ahead and end this poll. 58% of you think it will, 42% think it will not. So share those results real quick. So we're going to see. All right, so let's get on to the next slide. So Marlon, if you want to unmute yourself, open up your camera. So everyone, this is Marlon, who leads Upper 179D studies. So Marlon, real quick, do you want to touch on some common buildings that do not qualify for Section 179D and why that might be?
Yes, thank you, Nick. And great job with the presentation so far, man. So are going to be residential, anything that's let's say multifamily below like 3 stories, things like this will not qualify. Even though it may be a government-owned building, it still wouldn't qualify. Also, things like religious centers, churches, uh, uh, things like that, those buildings would qualify as well because it's either so. Anything else, I think, would probably be in those same type of realms for religious buildings like churches and things like that.
Okay. So if someone is looking for, clients that might qualify, like what kind of things should they be looking for? Like what features from their clients for getting work done that would help them qualify for a study?
So that's a great question. And believe it or not, there are some features that people may easily overlook. They may say, well, these may not qualify, but it actually does. So some key features that we see a lot of our mechanical designers putting into buildings are considered like pumps, VFDs, maybe CO2 sensors for lights, maybe some type of occupancy sensors for the mechanical equipment as well. And as far as like the envelope, something simple as roofing or windows, all these features play a huge factor in being eligible and qualifying for the 179D. You necessarily have to, design an entire or do a complete renovation or an addition. Just adding these features into some of these huge functions.
Gotcha. And then as far as like, so everyone kind of knows about Energy Star.
Mm-hmm.
What does that do? Like, how does that affect anything when you're going into looking at a building? Like if something is an Energy Star building, right? Does it automatically qualify or how does that need to be considered?
So
Oh, Marlon, you broke up a little bit. Oh, I apologize. Everyone, looks like Marlon's experiencing some connection difficulties. So I'm going to move forward a little bit on this without him. But so as far as, just because something is an Energy Star certified building doesn't mean it's going to automatically qualify for the 179D deduction, right? So when you're looking at a building, there's a certain way you have to model. There's certain things you have to look for. Energy Star has its own standards that come into play for this, and it's not necessarily the same thing that's qualifying for 179D. And this relates into the last question with how is the reduction in energy measured, right? You need to compare to ASHRAE standards, right? So ASHRAE has standards that are in place. Those standards are in place, for certain years. The one thing to note here is just because the I think you're back on, but just because the ASHRAE, just because a building's being done now, you Marlon, do you want to touch real quick on maybe some of the ASHRAE standards that are in place and how that could be deceiving to what actually qualifies?
Yes. So as far as the ASHRAE standard goes, I think my internet is kind of a little laggy. But as far as the ASHRAE standard goes, the goal is to kind of make sure that that building is up to date and up to those standards when it's placed in service. So what we're doing is we're comparing the current as-built model, the proposed model, what the building is actually doing with ASHRAE standards. So our goal is to make sure that when it's being energy simulated, that it's maybe 15, 20, 10% better than the actual standards. That way, that will determine the deduction amount the client is receiving. Also, I want to add, Nick, that it's possible to get a full deduction on just one element. So if you have an HVAC system that you implemented in this particular building, it can get $1.80 just alone by HVAC. It just depends how efficient that building is. Now, it's not necessarily the case when it comes to lighting or envelope, but it is possible.
Yeah. And so what people need to know, I think, is some of these states who have stricter building codes, for example, some of those building codes are going to put them in a better position for qualifying just based on ASHRAE standards
Correct.
alone versus other states.
Correct. And California's prime.
Yeah. Yeah. California was the biggest.
They're doing a lot of amazing things out there with their building codes and things out there. So if this is a new bill that you guys are working on and it's just meeting the standards, most likely it'll still qualify for what's an idea in a deduction.
Yeah. So that's something really to note. I think a lot of people might look at it and be like, well, I'm not using like super energy efficient bulbs, or I'm not doing a lot of energy efficient like in mind with the building. So just because you're not doing that, sometimes standards alone for certain states will help get you there. So it's something that's still worth exploring if you're doing any of these, the HVAC lighting envelope. So.
Oh yeah. I always tell people, as long as the building is eligible, it's worth taking a look at.
Yep. Perfect. All right. Well, thanks, Marlon. I'm going to get moving on to 45L here. And this is a little bit shorter section. And one of the main reasons is, as we'll get here, so essentially, who's 45L for? Developers of residential property, like that's who it's for. You must own, have a basis in the property during construction. So just like 179D is defined in the Energy Policy Act of 2005, and are currently expired at the end of 2021, though. This is why our unit is a little shorter. And I'm going to talk to Dave a lot about what we're seeing in upcoming legislation, maybe what we think is going to happen. But we're hoping that does get extended. It was supposed to be in the BBB, Build Back Better bill. It obviously that didn't go through, so it wouldn't be out of the realm possibly to see the program as it is now get extended. But Dave's going to touch on a couple of potential things that are coming down the pipeline too. But so if you do meet an energy efficiency requirement for these units, it can be $2,000 per unit. It's a general business credit, so it can't offset AMT. So that is something to be aware of if you're looking to claim this for a client. It could create some limitations on usability there. As far as what are the requirements, right? So it has to be 3 stories or less above grade. So residential buildings are small, stretched out. You get a lot of condominiums, you get some apartment buildings. But in the tax year, the credit is claimed, so construction must be substantially completed. And I can let Dave expand on that, but the unit must also be sold or leased, at least initially. So in order to actually qualify, each unit has to have a projected level of annual heating and cooling consumption as at least 50% below the reference dwelling unit in the same climate zone. And again, just like 179D reference dwelling unit, it's looking back at some previous year standards. So it's not necessarily that just because you're not building something with extreme energy efficiency in mind that it won't be able to qualify. So that's something to be aware of here. But building envelope component must alone account for at least 10% below the reference dwelling unit in the same climate zone. So again, we got to go back to what that reference dwelling unit is. And right here, it talks about it. It essentially is a unit that's similar in specifications and design, except that it is based on 2006 standards. So each unit has to meet the heating and cooling consumption targets by a qualified individual. You can't just have, again, just like 170, you can't just have anyone do this. You have to get certified in 45L, to be able to do this. Dave's gone through multiple classes for this, and there's certain bodies that can essentially issue these certifications to be able to take the 45L credit. But different types of properties, talk about a little bit, but apartments, you get student housing, condominiums, townhouses, any type of big development project where, like, if someone's building 200 townhomes, like those are the things you're really kind of looking for here. Mass development, because with this, volume is kind of everything. So the more you get, the more credit you kind of get. You can qualify with manufactured homes as well. It's just a reduced credit. It's only $1,000. And you only have to meet at least a 30% less than comparable house did of the 50 or the 10. But as far as the an example, if we have 120 units, we're looking at, let's say we get 100 of those to qualify, you get the 2,000 per unit, $200,000 credit. Pretty simple math. It's a credit dollar for dollar versus 178D was a deduction. So when these were looking at actual dollar for dollar offset of tax due. So it's much stronger in that sense. So let's launch polling question 3 before we get into the Q&A with Dave. So polling question 3, do you think 45L will be renewed?
Can I answer? Oh, sorry. Jumped in.
Oh, you will answer. Don't worry, Dave. All right, we got most people. You're missing a couple more here. I'll leave it over for another 10 seconds or so for anyone else to answer. And let's close it off. All right, so most of you thought yes, it would be renewed. We'll see what Dave has to say about that. But that's kind of leads perfectly into our first question. So Dave, will it be available for 2022 and beyond? What are you seeing?
Yeah, great question. I mean, first off, we don't know for certain, right? It's up to Congress and, you know, being a bet man, that's one group that I would never bet on to make a good decision. But short of that, I'd say popular opinion in the industry says yes, it's going to be available for 2022 and beyond. Fair amount of discussion that have been happening about the program and the future of the program in the last few years. And like you mentioned, and probably most notably, it was in the Build Back Better plan. And since that bill failed, it had since got in the mix for a budget reconciliation bill, and it's on the radar, and most of us just feel it's a matter of time. And we'll get to it in the next question too. It's just, what's it going to look like? But in its history, 45L has been available since its initial adoption in 2005. It has also in its history had some gaps where the credit was not available, but then renewed and retroactively restored. So in its history since 2005, it's been around and available with gaps. So like I said, most of us in the industry are just waiting until it comes through and what it's going to look like. But yes, I do believe it will.
Yep. So when it does come through, I mean, what kind of changes are forecasted for the program? And I'm going to kind of weigh this question 2 ways. You know, what are current people who are certified hoping for versus what are we hearing that they're looking at?
Sure. Yeah, I mean, kind of a mixed bag. I mean, as mentioned, it was they've been talking about extending and overhauling, and for a decent amount of time. At least when it was proposed for Build Back Better, it was proposed to extend for a much longer term, 7 to 10 years, I believe, was the proposal. So that was the positive thing. We're all hoping for that it's extended. So early discussions were to raise the bar. We talked about that it had to be 50% better than that reference dwelling. Early conversation said raise the bar and raise the credit. So raise it to 60% and raise the credit value. And that was really early on. And I think that kind of most conversations have gone away from that. In the proposal that hit Build Back Better and in the most recent legislations say it's basically going to look at revitalizing the Energy Star program for residential properties. So if you certified for Energy Star, you could get the proposal is $2,500 credit. So it's a little increase to the current standard, but there was also a caveat that if you qualified for Energy Star and Zero Energy Ready Home, you could get a $5,000 credit. So you talk about from an industry standpoint, what we would like to see the value be more enticing for builders, so they would consider going the extra mile to go after the credit. Arguably today at $2,000, if your local municipality doesn't require some of the more current technology in a home, you might not put it in the home because it's an extra cost that you may not get the value for. And at $2,000, it may not justify the means, right? But at at a $5,000 credit rate per unit, if that happens, to get to a zero energy ready home and to be Energy Star certified, that it's more of a, I don't want to call it a game changer, but it definitely, it brings it into consideration for builders to maybe put a product out there that is more energy efficient and go after the credit just by doing a little bit more, right? So, yeah. I mean, so just like the 45L program, Energy Star has been around since 2005. Energy Star for homes has been around. Energy Policy Act put it in 2005. It's reduced over time in its value for residential properties. Like there's always been some Energy Star incentives and credits for homes. They've not gotten better. So similarly, the zero energy ready homes through DOE, that program has been in place for many years, but it's never been tied to 45L or to a tax credit of any substance. So most of us, and I personally, would like to see it tied to a more stable program like Energy Star. Love to see the credit increase, and we're hoping for that. But also in the meantime, we're hoping that the credit just gets extended as is for a few years to let the industry have time to adapt to the new programs and the pathway to 45L. But it's one of those things. It seems to make sense. You just don't rely on Congress to do something that makes sense.
So yeah, it'll be extended, and then they'll wait for the next deadline and then try to overhaul at the last minute again, and then gets extended again. So that's always the problem, is getting everything done at the last minute. So all right, so leading to the next question. So as far as prior year properties and projects that were done, or if they're currently occupied, what does that do to their ability to claim the credit?
Yeah, I mean, so the credits expire, but we can still go after it. So on both cases, occupied properties or homes that were completed at a substantially completed level and were initially leased or sold in the prior tax year, we can go after it. It's also very common, if you imagine that if you're going after prior year properties, they're probably occupied. So yes, you can do both. So occupancy is not a requirement, but it comes up a lot for obvious reasons when you're looking in history. You can pursue 45L for any open tax year. So you do got about 3 years, depending on situations of prior filings, right? So if it's open and available, you can go after it, but it's a general business credit, so you'd have to amend to go after that. In some cases, that isn't even come up as an issue. In other cases where there's a lot of interest in a property, like a large development that wasn't claimed, but there's 30 shareholders, we sometimes see that as a deterrent to go after 45L for prior ones. But I mean, occupied units can logistically bring up some challenges, because there is a physical inspection requirement for 45L as well. But I will say for larger developments that are still active, let's say they're still building into 2022, but they had units in 2021 or even in 20 that met the requirements, and they're still building phase 2, phase 3, or whatever they're on. In some cases, we can use existing properties, evaluate the ones under construction, and sample them to represent homes and properties that were developed in the past. That's kind of on an individual property to property basis, but it's definitely something I would look into for larger developments still active. Let's talk about how to sample them and go after prior years. It's definitely worth a look.
Yep, absolutely. And I mean, along those notes of obviously having occupied properties and having to try to deal with that with doing site visits and blower door tests and all that. So how difficult is the certification process? Like, what kind of success rate are we seeing? Like, what does it look like?
Yeah, I mean, so common question, right? It is not saying that, the best way to say this, most new properties, newer constructions that are built to a code that is close to current are a good chance of qualifying. It doesn't mean all new properties are going to qualify, but they got a good chance. So the certification process, at least on the initial stages, doesn't vary whether it's occupied, whether it's 2 years old, or whether it's current. And whether our process, we would call it an initial a feasibility analysis. The industry, they call it something, where you're doing some initial evaluations of the property. We'll collect drawings, we'll collect some other mechanical information about the unit and do a feasibility, kind of a hands-off feasibility analysis. So on the front end, you're evaluating, does it even make sense to look at 45L for this property? It's not evasive. It's not that difficult up front, right? And at that point, we've got a pretty good indication of whether these properties are worth looking at, which means it's worth trying to schedule a field study. It's worth pursuing because the qualifications look good. At that point, it does get a little more logistically complicated because you've got to arrange schedules and with occupied properties potentially, or around your construction process if they're active. But I mean, those are pretty easy problems to get around. So, I mean, the certification process does take a little bit of time, but I wouldn't rate the level of difficulty very high, especially if that's a factor in considering 45L. The initial steps are pretty painless. Collect some documents. You're going to take a couple of weeks of time, but then you'll get back an indication of whether it's worth pursuing or not.
Yeah, and I'd imagine that's one of the big things in the industry that's kind of barring people. They might think like, oh, well, all those are sold and occupied, so how am I going to do anything like that? So that's really good for everyone to understand and know that, just because these are sold, just because they're occupied, doesn't mean you can't go do this and it's not going to, it's going to be a giant hassle. You can still go do that. So thanks for clarifying that, Dave, and answering all those questions.
No problem.
We have no Q&A, so let's go on ahead to Cost Seg. All right. So cost segregation. What is cost segregation? So cost segregation study is accelerating depreciation, which what otherwise would have been depreciated over longer lives. So you look at a building, I mean, very similar to 179D, where we were taking, the bill, the envelope, the lighting, the HVAC, and we're taking those 39-year things and bringing it forward. Cost seg is kind of everything else. So when we're looking at cost segregation, we're looking, okay, like what else can we pull out of a building and pull forward into a shorter life class? Because when you buy a building, for example, you're going to have all different, it's all going to be categorized in one life class. So we're going to go ahead, break it up, find everything and get into different life classes. In order to do that, we need to know the place and service date. We need to know what the original recovery period is, the 27.5 is a 39, residential versus commercial, what convention is being used and what is the property class and method. So we want to the goal is to try to pull as much as we can into tangible personal property versus the real property in a longer life. Essentially time value of money, taking what would be a longer depreciation, bringing forward into the next 5, 7, 15 years, or even into today. And we'll talk about that with bonus depreciation, how that works. So again, here's a quick visual, 27.5, 39-year. You can break things into land improvements QIP or 5, 7 year life values. So, so anything that's a building or a structural component is termed as real property. So we have a straight line method, which is, for 1250 property, again, 39-year, 27.5. Our goal is to get everything into 15, 5, and 7 years, where we can depreciate it with a more accelerated depreciation method. And this will also fall into 1245 property once it gets into the 5 and 7 year. As far as who are good candidates for cost seg study, this is what you gotta love about cost seg. It's pretty much every building. So it could be acquired or inherited properties. It could be new construction. It could be a build out or renovation. The things when you look for is, okay, if it's been placed in service after 1987, if it has a substantial amount of remaining life in the asset, right? You don't want to do a cost seg study if something is mostly depreciated. I mean, there's not going to be much time value left there. And then you want to, again, how much service, the original place of service date, the remaining life of the asset, and then make sure it was placed after 1987. The main 3 things to consider. Here's some average reclassifications. These aren't definitive by any means. It can fall outside these ranges. It can fall smack dab in the middle of these ranges. These are just what we, can typically count on or see in the industry. There are some interesting ones on here. You look at golf courses, 20 to 40%. Restaurants, lots of people, restaurant clients. Manufacturing is a big segment of what we do with a lot of the credits we're based in. We're working with a lot of manufacturers on R&D. We're working with them on 179D. So that falls into a lot of things. But you can see not every building is the same, right? If you have something that has a lot of components, a lot of parts to it that aren't, built into the building envelope itself, you're going to be able to pull more out than something that's kind of just a, just a shell. So bonus depreciation, I talked on it a little bit, but what is it? It essentially allows us to take, a large percentage, or all in this case, of qualified property in the first year if we're able to qualify for bonus depreciation. So what is qualified property? MACR's property with a recovery period of 20 years and less, and which does include QIP, and there were some changes with that that made that happen. But essentially, anytime we're doing a cost segregation study, we're looking at things, trying to pull it into those, remember the 5, 7, 15-year life, that all falls into the bonus property bucket. So there are, as far as other things that, meaning with qualified property, there's computer software, water utility, qualified film or television production, and, theatrical production. But for cost segregation, obviously, we're looking at buildings here. So any eligible property that gets placed in that 5, 7, 15-year bucket can receive 100% bonus if it was acquired and placed in service after September 27th, 2017, and before the end of this year, so before 2023, essentially. After that, it does phase out by 20% each year for the next 4 years. That is something we'll see if that ends up changing. But the thing to know is bonus depreciation is essentially saying, hey, if you have something that's, let's say we have a $1 million building, and we're able to break out 25% into those shorter life classes, like we saw on some of those charts. Okay, so 250,000, that would normally be over 5, 7, or 15 year. Now we're taking that 100% year one, bringing that all into today's dollars, and able to get that deduction, increase cash flow, and now turn around and put into other investments. It's a big deal. And the one thing to know is, there is still tax planning involved with this, right? And we'll talk about this a little bit on the next page, on the next slide. But you don't want to, obviously, not every single person might benefit from bonus depreciation, which sounds, strange in and of itself, but we'll talk a little bit why. But one of the other things to know is used property is eligible. It used to be just new construction, but now it can be used property as well. So as far as bonus depreciation, you can elect out if you do not want to claim bonus depreciation. You have to do it for each class of property. So why would someone ever want to elect out of taking a bunch of money? Well, I mean, who knows? Maybe you're going to have someone who in the current year, their taxable income is really low for, a one-off event that happened to their, to themselves or their business or something. So they're in a lower tax bracket. Well, that person, it might not make as much sense to do today versus, doing over a couple of year time frame, right? So that's just one situation, but every single client is different. You can look at different tax planning strategies, and does it make sense to take it all as bonus, or are we better off taking it as 5, 7, or 15 year or whatever? If it was placed in service before 2017, there are, or before September 28th, 2017, that's a very specific date. There were old phased down rules before the Tax Cuts and Job Act, created the 100% bonus. So you can see the chart here. There's 50% for 2017, 40 for 2018, 30 for 2019. That was in place. But yeah, so the bonus, essentially, what will happen after 2027? That's what we have yet to see. It's something that we would expect to have something in place. In reality, bonus is there to stimulate the economy. You're trying to create more cash right now, to create investments, to create cash in the economy for the taxpayer. So if Congress decides to extend bonus, it's likely going to be to stimulate the economy more. So again, everything will depend on where we're at that time. We'll see if that's something they look to do. But as far as, we talk about QIP, qualified improvement property. So this has had quite a few changes over the years for multiple different acts, but it was introduced in 2015. It originally, it means, any section 1250 improvement made by the taxpayer for, which for a commercial building, so non-residential real property, as long as it's placed in service after the date of the building was first placed in service. So what does that all mean? You can't buy a building, tear it all, tear everything out, do your improvements, then place it into service and claim all those improvements as QIP. No, it had to have been placed in service, and then the renovations get made after that. So what is that after? There's something Harry can touch on, but is it a couple months? Is it a year? I mean, the safe thing would probably be after the end of the year that was placed in service, but I'll let him expand on that a little bit. But so there was a retail glitch, but you can now get bonus depreciation on QIP. It wasn't eligible for bonus in the past. CARES Act did fix that, and now it's bonus eligible, which again, so now you're doing a bunch of improvements to a building. Now you can take that all in the current year. So I mean, if you have a build out that ends up being fully qualified as qualified improvement property, you can now take that full amount just as an expense, a deduction in the current year, essentially, as opposed to putting it into whatever life class it would fit into. So there are limitations on what QIP is. So again, we talk about must be after the building was placed in service. You can't enlarge the current building. It has to be within the current structural framework that existed. So you can't be changing the structural framework. You can't be doing an enlargement. It also doesn't work for elevators or escalators. So pretty much any type of renovation type improvement where you're not going to be changing how a building is built structurally or anything like that, you're likely to be able to take a lot of that as QIP. And it has to be, again, made by the entity claiming the deduction. You can't have a tenant who's making leasehold improvements and then go ahead and claim QIP on that as the owner. No, that doesn't work. Yeah, that's pretty much QIP. And this talks a little bit about how this has changed over time, but I'm going to speed through this a little bit because we're running out of time here. Essentially, it failed to assign a 15-year period for QIP. And so that's what CARES Act fixed. It gave it that 15-year period, so it would qualify for bonus because it did not before. So polling question 4. Let's get this one up. Last polling question of the day. And this is, do you think Congress will extend 100% bonus depreciation beyond 2022? We got about 75% of you answered so far, and it's split pretty even. Actually, more people are saying no than yes right now. Looks like we have everyone except 1 or 2. Give another few seconds here before I close this up. I personally, as of right now, tend to agree with you guys that I don't think 100% is going to be extended quite yet. Unless they do fear a recession's coming, I wouldn't be surprised to see them do that more. But Harry might touch on this as well. Okay, we're going to end the poll. Share the results real quick. So as you can see, 48% of you said yes, 52% no. Go ahead and stop sharing that. And let's get to the final Q&A part. All right, so we got some FAQs. Harry, so everything I talked about was federal here, but so we're talking about QIP and bonus for state purposes. Do people have to be aware of anything? And if so, what do they need to take into consideration when planning with their clients?
Yeah, good point. So QIP, as everybody knows, is eligible from the federal level. And when we are issuing feasibilities, we as a firm take a conservative approach of not including the state tax. But when you guys get the results from us, you actually come in on a positive or on a higher side, because if if your client is in a state where bonus is eligible, or they conform to the federal rules, then you kind of have a little bit upside. But talking specifically about QIP, so first of all, we got to understand not all states conform with QIP and the bonus rules, right? Second, some states still depreciate QIP over 39 years instead of 15 years. And then third, like a state can treat the QIP property on three different things. So the state might have conformed with the Federal Tax Cuts and Jobs Act, which was a retail glitch, right? Still have 39 year, or they could have conformed to the CARES Act. And third, they could have decoupled themselves from bonus depreciation. So for example, like where I'm located in California. So you can depreciate a property in California over 5 years and 15 years and whatnot, but California does not conform with bonus. So on the federal level, when your client is doing a cost segregation study, they will see a huge deduction because as a result of a bonus depreciation, but they're not going to get a lot of deductions from the state side. But it doesn't mean you shouldn't do a cost segregation study, because it's still better to depreciate over 5 year and 15 year instead of 27.5 year or 39 year, right? So the first thing you should check is, does the state conform with TCJA? So the states that are conforming to TCJA is also, they're literally conforming to the language and removing bonus depreciation for QIP. And there are states like California, like I said, were not impacted because they do not conform to the maker's depreciation anyway. So even if they're not conforming to TCJA, it doesn't really matter because bonus depreciation is not given either ways, right? But yes, it does impact, because for TCJA it was already 39 years, so it doesn't really matter, right? So now the second step comes out to, okay, if you do conform with TCJA, now when the CARES Act came around, did the state switched from TCJA to CARES? Did they conform with CARES? It could be that they didn't. It could be that they did. That's the other thing that we have to kind of see. If a state confirms the federal changes, which will reduce the maker's recovery period from QIP from 39 to 15 years, it may depend on the state adoption of CARES Act, right? And there are states which have not conformed to the CARES Act, right? And then the third thing you got to look at is, did the state decouple from bonus depreciation? Like if there's a state and they said that, yeah, we're not going to take bonus depreciation. So even though you have 15-year QIP on the federal level, you still do not get bonus on the state side, but it's still better than depreciating over 39 year, right? You're still getting it over 15 year. So I'm not sure if I confused you more or I gave you more information, but bottom line is, states and Fed have different rules. There are certain states that will conform with Feds, and there are certain states that will not conform with Feds. But when we are issuing feasibilities, we are always on the conservative side. So when you do apply the results, you're not kind of misleading you. That's what I'm trying to say. You're not misleading you. If anything, you'll come out better.
Yeah. Yeah. I mean, each state, it's definitely, this is where, as a CPA, right, you're looking at your clients, you can establish value here. Say like, okay, like this is how we're going to have to treat this at the federal level. State level is going to be different, but we're always going to put you in a position where we're presenting, and come out ahead of that. So that's definitely good to know. So we're running out of time here, so let's speed this up a little bit. So inherited property, is there anything with inherited property and getting bonus depreciation?
Right. So as we all know, right, thanks to President Trump, Tax Cuts and Jobs Act give used property with bonus, and I get a lot of these questions from our clients when used property we're not getting bonus. Hey, what about inherited property? So Section 743 step-ups are excluded from bonus depreciation. So it's kind of like you cannot buy a cake and also eat it, right? So you are inheriting a property, you cannot get a bonus depreciation on it. So that's a fairly simple answer. There's no other way around it.
Yep. Okay. Yep. Good to know. And then, so you want to cover the passive activity loss rules real quick and how that can apply to cost seg study?
So, I mean, this is like a big code section I can dive into. Like we're running short on time, feel free to reach out to me after this webinar. We can dive more into it. Section 469, it talks about all about passive activity and, passive income and active income, and it's not active income, it's non-passive income as per this code section. generally speaking, if you do a cost segregation study and you do not use all the deductions in the year when you're doing a cost segregation study, it's going to go to a bucket known as suspended loss bucket, right? And it will just stay there until you have enough passive income to offset those losses. So remember, you cannot offset your passive income with active losses. You cannot offset, vice versa either. Only passive income with passive losses until and unless you do an election, under, it's a grouping election in which you can consider it as a single economic unit, then you can offset active income with passive losses, but there are a lot of limitations to it. You got to read into the regs and kind of see if that could apply to you or not.
Yeah. And that circles back to the same point of who's, types of clients who might not want to take bonus depreciation. If you're just going to be creating this giant, loss in the current year, you might as well let that roll forward into the other years, and you don't have to worry about that. Then maybe you'll be in a higher tax bracket then. So
yeah, absolutely. Yeah. The whole thing about cost seg is a timing, right? Mm-hmm. Just remember that. If you think you have enough losses, you might be better off having a $30,000 income and paying a tax on it and do the cost seg next year when you're going to have $300,000 worth of income and then apply a cost seg and reducing the income. It doesn't make sense for you to do a cost seg when you're already in the smallest tax bracket, So it's a timing thing. You got to keep that in mind.
Yep. And then the last thing we'll touch on, so, and this kind of along the same point. So if you did a cost segregation study and you never used those losses, like, what happened? How long does that bucket sustain? What goes on with that?
So it stays forever, right?
Yep.
It gets suspended, and it's a bucket that it just keeps on accumulating, and it just keeps on waiting on you to have enough passive income so it can be used, right? Until like I said, you use a grouping election. It doesn't get expired or anything. Any losses just carries forward. And a lot of people come to me and ask me, hey, do I have to do a cost segregation study in the year you acquired? Yes and no, right? I mean, if ideally, if you do it, you have less compliance issues, sort of like you don't have to file 3115. If you do not do a cost segregation study in the first year, you're still fine in the second year because you can amend it and going back and amending it. But if you have filed tax returns for more than 2 years, then you're going from impermissible method to a permissible method. Then you have to file a change of accounting method, which is a 3115, which you can fix it, which was Nick was, during the presentation mentioned about change number 7, and that could, help you fix that. And it's called 481A calculations that you have to run. It's the, the missed deductions, all the deductions that you should have taken. You're telling IRS, sorry, I didn't take it. Now I'm fixing it. Now I'm taking it now. So it's not like, it's not a huge compliance on you that you have to go back and fix each previous tax year's return. You don't have to. You just do a 481A calculation, just one form, file it, and submit it with the IRS.
Perfect. All right. And then last question, just quick, 30-second answer. Do you know if bonus depreciation will get extended? Are you hearing anything in any of your groups?
From our resources and from my colleagues and who I work with, the news from Washington is they are not, right? That's a no, because the state of economy we are in, the feds are they're dialed in completely to lower this inflation, and they're not gonna give 100% bonus depreciation or say like unleash the lion again. They're not going to do it. Their whole point is to lower the inflation. That's the rhetoric that is going around. Hey, we might see a change the following year. Who knows? It's still not bad, guys. I mean, you're sitting at 100%. Next year is 80%. Following is 60. And typically when you go from 80 to 60, and lower on, then it kind of people start to dwindle and think maybe we should change it. So I mean, it's a cyclical economy we are in, right? Things keep on changing, and people, as the new president come in, he might change. I don't know. Maybe Biden will change his stance on it. I don't know.
Yep. All right. Well, thank you, Harry. And that's it, guys. That's everything. I want to thank everyone for attending this. We had all of our attendees are pretty much still on board this late in the presentation. Really appreciate everyone listening. Really appreciate, Dave and Marlon and Harry for you guys' insight on everything. Thank you guys. And until the next webinar, we will see you guys next time.